So in the chat area, I've just uploaded a file which you should all be able to download because what I want to do today is just do a bit of an interactive session between the 7 of us and essentially go through the process of building a forecast, the kind of things to consider and why things need to be split out and separated and why certain things need to be combined. So we'll partly build it and then I'll talk about the technique in building it at the same time. So if you go to where it says chat, and then you should see a file there. Can everyone see a file in the chat area?
Bottom right corner.
No, Nishi, it's Stephen here. I can't see it. I must have joined after that was posted.
So. Oh, okay. Let me just upload that again in that case. Okay, I've just shared it again. So
yeah, thanks.
Okay, is it all there? Yeah, perfect. Yeah, so this is the file that we're going to be using today, and what it is. So I'm going to build the cash flow with you after I've just done a brief discussion of why cash flows are quite important, and then we'll just discuss some of the best practice while we build it together interactively. And then the idea is you'll be able to go and take that model and then use it for your own kind of stuff. So I'm going to start by sharing my screen. Can you all see my screen?
Yep. I think.
Okay.
Well, yeah.
Yeah, perfect. So I've dispensed with the PowerPoint because I just wanted to do this bit quickly so we can spend a bit more time with the building of it all. So I just wanted to go into a couple of reasons why. Hello? Hi. I just wanted to go into a few reasons why, and apologies, I know there's 5 reasons there, but it says 4 there. A few reasons why it's important to keep a cash flow. Firstly, what a cash flow is instead of having a profit and loss, which you might get from your accounting software, which tells you how well you did last month, a cash flow is about looking at what your business will look like a year or 2 years or 3 years down the line. So the thing about a profit and loss is it's a very reactive process. It's like, oh yeah, that went wrong last month. If I'd known it was going to go wrong, I could have done something about it. But now all I can do is talk about it having gone wrong and maybe learn some lessons for the future. The whole point about the cash flow is it's a model where we're creating a sort of picture of what the business will look like based on certain assumptions. And if you create that picture of what it will look like in the future, you can see where there's potential problems and you can then have the opportunity to actually deal with those problems before they arise, which makes it a lot easier to sort them out. You can imagine, for example, if you're going to run out of cash, there's probably, and James will be able to attest to this, there's probably a lot of lenders that want to lend you money while you have cash, but not many that will want to lend you money when you don't have cash. So understanding you're going to run out of money when you have cash is ideal, especially if you're trying to get funding in that scenario. So that's one of the main reasons, figure out if there is a point where you do run out of money so you can do something about it. And the other side of running out of money is having too much money in a business. And, some people be like, wow, that'd be the life. But actually what too much cash in a business represents is underutilized potential. As you can imagine, cash is one of the key elements of growing the business, and it lets you invest in certain strategies. And if you've got money building up and you're not expecting it and it's just sitting there and you haven't made any plans to do anything with it, then in the long term your business is going to be smaller than it could otherwise if you had invested that wisely. So we're not just looking to build up loads of cash in a business, we're looking to maintain it at a certain level between certain confines. That's relative to each individual business. Some people say, well, I just want to cover my overheads and my staff for 4 months in case something like coronavirus happens. So fine, fair enough. That's their strategy. So they'll work out how much cash they need to cover that for 4 months. Some other people might be, well, I want a year's worth of that in the business. So it's based on people's risk appetites. But the key thing is cash and the amount of it in your bank should always be a target for a business. And then, so one of the toughest things in a business, although what I'd say is these days it's getting easier than it might have been historically, is now people are now it's possible to pay a lot more stuff on monthly direct debits and standing orders. So it makes things a little bit easier for your cash flows. And, you know, sometimes if you've got the opportunity to do something monthly rather than quarterly, I know you could, in theory, earn a little bit more interest by keeping it in your bank account a little bit longer. But I always take the monthly option just because it makes things much easier to keep track of. And I forego those pennies or a few pounds in interest that I'd save. But there's still annual costs your business is going to have, whether that's your business insurance, whether that's certain things like your VAT bill, which has got to be paid quarterly. Then ultimately, it can get very difficult to actually manage those. So the idea of creating a cash flow forecast is really that we can actually model those quarterly and annual costs as well into it, and then that will form part of your overall plan without you having to do too much keeping track of it all. One of the other great things about creating a forecast is you can create what if scenarios. So like, you know, if you think you're bringing in a salesperson for your business, you know, it'd be easy to say, okay, the salesperson's going to cost me £2,000 a month, but I'm going to bring in £4,000 of sales. So I'm making a profit of £2,000. But the thing you've got to consider in the middle is essentially, like, you've got timing difference. Like, that salesperson might come into your business straight away, but the benefits of having that person in your business might not start to arise until like 6 months down the line, until they've built up that pipeline, and then that might be a gradual phasing in as well. So the whole point of the cash flow is, especially if creating like a 2 or 3 year one, is it lets you understand those timing differences. And, you know, while an idea might seem profitable on paper, and when you look at it as a long-term thing, you just got to see how your business can manage the cash flows to actually deal with that. And then one of the last things, which the spreadsheet might not help you to do as much, but there are some really good forecasting software that will, is it tests your assumptions about your business. So, you know, I've come across lots of business owners in the past who think they're like, you know, their HMRC PAYE bill is like £300 a month, but actually it's more like 500, because they've just built a figure in their mind and never really tested it. So by actually looking at what you've got in your forecast and what it's doing in terms of reality, and comparing to your actual financial figures, you get an understanding of what you believe about your business being correct, and where you need to have another think about your assumptions. That leads to better decision making in the long term. Does that all make sense?
Yeah, looking good.
Okay, all right, great. Yeah, so I'm going to get straight into it. So what I'm going to do is I'm just going to open up my cash flow model here. So this is a simple forecast model that I've built for you guys. It looks complicated, but the idea is, like, with a forecast, because you're building something today that you might only look at again in 6 months' time. I mean, you'll always be looking at the forecast ideally, but you'll be looking at different elements of it. There'll be parts of it that you look at every month or every few weeks, like, you know, the end bank balance or the net cash movement. But there'll be bits of detail that you only go into every now and then when you're analyzing a particular part of your business. And you could create an element of this forecast and not look at it until 6 months down the line. So the whole point of this is to actually have a certain level of granular detail where you can. Just so down the line, when you do look at something and you're like, why did I put that in there? And you can't remember because it was 6 months ago. Then, you know, something like, especially being able to stick comments in. Like, I don't know if you're all familiar with the comments function in Excel, but you can start typing things in, like, what is that? So widgets, and then just put like £500 there, and you can make notes that way, and it all builds in, and then you can get an understanding of why you worked out that particular budget in that way. So what I wanted to do to get started on this is just give you a brief overview of how I've created this model, and what essentially what it all means. So when you're looking at a forecast, there's a few elements of it. You got your starting bank balance. And let's say you had £10 in your bank account today, then someone gave you £30. It would mean you had £40 in your bank account. And then let's say you went out and spent £20. That would mean then you then had £20 left in your bank account. And that's essentially what the forecast does. It takes the starting point. So this is like, what you had in the bank balance at the beginning of the month. It works out everything you've got coming in terms of revenue. It works out everything you've got going out in terms of cost of sales and overheads. And then it will give you an idea of what your bank balance will look like at the end of the month. So just before I go into the interactive bit as well, actually, no, I'll start the interactive bit now. Can anyone tell the difference between a cost of sale and an overhead?
Anybody?
Yeah, can hear, yes. I can.
Go on then, Stephen.
Oh, there's a question. What was the question?
Oh, yeah. Stephen, what is the difference between a cost of sale and an overhead? By the way, I know, but I'm asking. I'm trying to
What's that?
An overhead is something that's fixed, usually on a monthly basis or an annual basis.
Okay.
Cost of sale is a cost that is directly attributable to a sale that you wouldn't have if you didn't make a sale.
Yeah, exactly. And that is pretty much how I would have phrased it. So,
win.
So, yeah, it is. No, that is good. And do you know the importance between being able to distinguish between the two?
Oh, the questions are getting harder now, Stephen.
The importance. If you make no sales, you still have your overheads.
Yeah.
And so that'd be important to distinguish what your overheads were. And it would also be important to distinguish what your profit margins are, so that you know what each cost of sale is, and you know what each item or widget or hour or whatever you're selling actually costs you.
Yeah.
So you can work out whether or not it's worth doing or not.
Yeah, that's fair enough. I think so. What I'd add to that is you'll also end up with some overheads which are semi-variable. So let's say like you've got staff in your business that don't relate to one particular sale. But if your sales volume like tripled, you might need 2 of those staff instead of 1 of them. So there's some overheads that are completely fixed. There's some overheads that are semi-fixed, and then these cost of sales are directly related to each sale, or loosely but directly related to each sale. One of the main reasons it's quite important to be able to distinguish between those when you're forecasting is one of the starting points really for a forecast is just to work out how much money you've got coming in. And then the other side of that is really to understand then what your cost of sales will look like in relation to those sales. So that's actually, we're modeling a sales profile, then we're modeling the costs on the back side of that. So as a starting point, let's just call it a consulting income, right? And I'll suggest a figure here, and we'll call it like was it £15,000 coming in for consulting income. And what I'm going to do is I'm just going to copy that to the end of the forecast, and the reason for that is, and one of the key things whenever you copy things in a forecast is if you select this cell area and then you right click on it, you can see a little thing which says FX, which means copy formulas. So one of the things I've always tried hard to do in all of this is to make sure that all of these formulas and cells are nicely formatted. So really, as part of that, it helps to only copy formulas where you can, so you don't mess the formatting up. And what we've got here is anything that you should change is yellow, and anything you shouldn't change is a different color. So if it's this color of yellow, it means you're fine to overtype it. If it's anything else, it means you're going to mess the forecast up by overtyping it. So let's say you're a business that does mainly consultancy work. You might have ad hoc consulting work, for example, ad hoc, and then you might have retained consulting work. So let's just say that looks like £10,000 a month as well. So let's just push that out into the end of the forecast as well. So let's leave it as that for the moment. And then what we've then got is we've probably got cost of sales relating to that as well. So I think if you're a consulting type business, perhaps you could suggest a particular cost of sales you might have. Mark, is there a particular type of cost of sale you have relating to your business?
Well, we provide some software, so they're a cost of sale.
Okay.
So say for argument's sake, if we
Yeah.
charge someone £500 a month, but £100 of that is on the software
Okay.
that puts them in, then the software is comes off the sale, doesn't it?
Yeah. So, and that's per customer. That's not based on your business in general, is it?
Certain customers.
Okay. All right. Fine. Yeah. So let's put customer software. Okay. Cool. And so we'll say that's about 400 quid. And so just bear in mind here, you just need to go into the negatives if it's something going out. So I'm just going to push that out to the end. So that's cool. So yeah. And can anyone think of any other types of cost of sales they might have?
Raw materials.
Okay, yeah, raw materials. I don't typically tend to see those in consulting businesses that often, but
Oh, if you're talking about consulting, 100%, then no, maybe.
let's put teaching materials or what's called course materials. We'll call it materials, yeah.
Yeah, stop spoiling your spreadsheet, James.
Sorry, yeah.
All right, so we got that as well, and
How about subscriptions?
well, subscriptions, are they, hi Mark, you're right, housing. Are they directly related to the sale you made, or are they for your own business?
Might be if it's a Zoom meeting subscription, and you have to use it to do your job at the moment.
I think that's a good point, but I would call that an overhead because you can
payment things that people use.
Yeah, I do have a section further down here for subscriptions. So what I've tried to do here is I've tried to separate the cost of sales out here, and then I've tried to have all the overheads down here. So should we move on to like advertising and marketing? So let's say we just got a few costs in there, like advertising. Businesses might spend about 200 quid a month on it. Networking call. I think Paul's subscription is like 26 quid. You might be spending about 100 quid a month on your website, for example. So let's get those in there as well, and we'll move that down to the end of the forecast. So, and you know what I'll do, just to be kind here, I'll put a nice starting balance as well. So we've got money coming in so far, and then so what I've tried to do here is this all, because when you look at it every month, you might not want to go into loads of granular detail. So it's really useful on a forecast to just have it collapse down. So what I've done is I've used the groupings on here to, I don't know if you've all got the latest version of Excel, but I think most versions of Excel do this. But you've got groupings there, so you can expand it into all the detail. And then you can collapse it into the non-detail. And, you know, whenever you enter a figure in, you can always add a comment and put, like, if, let's say maybe 3 or 4 different things went into that figure, you could add those lines into the comment. So then in the future, when you look at it, you'll be able to just remember what you, why you put that in there. And then if you've got a comment there, you can always copy and paste the comment to all the other cells it applies to as well. So it's quite useful that way. Mark, I don't know if you saw the file which I put into the comments, but what I'll do is at the end of this, I'll save this down and send it in to you again via the comments. Okay. Yeah. So like there'll also be things like bank fees, and then there'll be other potentially costs relating to consultancy. Let's say, like, you know, you've got to sue someone or someone's suing you. You might have to get Alvaro loan in, and he'll charge you like 300 quid every time you get sued. But, you know, some of these costs might only be every now and then. So, like, you know, consultancy, it might not be It's broke my own rule there. It might not be a monthly thing. It might just happen sporadically, like, you know, every few months you might just get sued and might need to get a solicitor involved. So accountancy costs, like, you know, if you've got a reasonable accountant, they won't look like a lot. That's generally monthly, but, you know, you might have an accountant that just charges you annually, and you would just stick those figures in there. Bank fees, depending on your bank as well, that could look like about £6 a month potentially. And then, is anyone thinking of buying a laptop anytime soon?
Obviously not.
Okay,
Answer maybe.
it's yeah. I mean, so you might have to replace bits of equipment and stuff like laptops and computers and stuff. So that might be, you know, like £700 going out every year or so, depending on how many staff you got. Office equipment, you're all working from home, so you're probably buying, you know, fancy new chairs or something. So maybe a few things in there like that, and maybe you have to buy, like, you know, something further down the line. So we're modeling that in. And then certain things, like if they're relatively small, you don't need to go into too much detail with them. Like maybe just put in a notional amount for things like printing and stationery, rather than trying to figure out the exact amount you spend every month. I think with forecasts in general, you sometimes have to apply the rule that if it's below a certain amount of money, don't overthink it. It's just like, you know, put in a notional amount, and whereas if it's a larger bit of expenditure or income coming in, then model that in carefully. But so yeah, maybe you're paying, like, you know, £400 a month in rent. So some of those costs will just need to get pushed out. And then, you know, general expenses. So one of the key things I'd recommend when you're doing this forecast is these categories you got here, they can be renamed to anything you want them to be. I typically try and leave cost of sales as cost of sales and revenue as revenue. But the key thing is all these overheads, the best thing you can do is get them to match your accounting software as best as you can. And the reason for that is when you're looking at your profit and loss from your accounting software, it'll make it a lot easier for you to compare certain items to the forecast that you had. So for example, every month you could just save this forecast down before you replicate it for the next month. And as part of that, like, you could then also have a look and say, well, this is my profit and loss. This is what I thought I was going to do, and compare the two. And that'll give you a good understanding of, essentially a good understanding of where you're over and underspending compared to what your plans were. Could someone describe, like, maybe a general expense they've got in their business that doesn't really come under any other category?
Tea and coffee.
Okay, yeah, that's cool.
I'll be about £200 for Mark.
200 quid of tea and coffee.
Yeah, ban gin from the office, Paul.
Refreshments.
Well, we're not doing Dawn spreadsheet.
No, keep Dawn out of trouble.
Yeah, it's and then what kind of insurances do people pay for?
PI and PL.
Yeah.
Okay, all right. So and they might be like monthly, I suppose. So sorry, annually, maybe. So you know what, that will be June. Okay, and then you have it again. Yeah. What I'll do, actually, just to make this a little bit easier for us, is I'll freeze that pane. So yeah, so we've got that, and then really, then you got like salary costs in here. So if you got, I know some people don't have staff. So one thing I'd say about salary costs is don't put your director's salary in this line. And the reason for that is I've got an area down here for drawings. So I always put director's salaries through as a director's loan transaction. So this is just purely about your staff, like, you know, what kind of staff are you paying, and what does that look like? You could potentially split it down into loads of different different categories, like, you know, the PAYE you pay, the pensions you pay, all the individual staff you pay. And it's possible to do that, or you might be better off just leaving it as one line there and just adding it as a comment or a note essentially. And then you might have bits of staff training that you've got to do every now and then just to make sure they're up to speed. So then business probably have like telephone bills. They might be paying for accounting software potentially. If this is based on mine, so you might not have accounting software, but just bear in mind those are categories that are there that you can just overtype if you want to. So and you know, this is Mark. This is where you might put in your subscriptions, for example. Is there a particular subscription you have?
There's two marks on the call, Nishi. So you
Okay,
need...
Mark, or I think you mentioned subscriptions earlier, didn't you? Hi, Mark. Okay, but I mean, don't worry about it. Like, you know, subscriptions just could be like industry publication, which, you know, you might be paying like 30 quid a month for or something, and it's something you just pay for over the course of a year. So, you know, the key thing about this model is it's something you can make your own. You can rename some these cells, and you can call them wherever you want. What I've just tried to do is just try to keep them sort of categorized as best as I can, just to make things simpler in the future and make it easier for you to just read the summaries. And then, yeah, you might be doing bits of traveling with your business. So you might have motor vehicle expenses or travel costs. So, you know, that might look like a bit. And to be fair, there's probably somewhere where you need, I'll call it travel and refreshments. So you might be buying train tickets with work, or you might be going to meetings and buying coffees, and then you might also have a company car where you've got certain vehicle expenses for that, so they can go in there too. And this is the drawing section, is where I normally put, like, you know, how much money you pull out of the business. And I've got something which says loan here as well. So if you've got other businesses where you're siphoning money off to for various projects, you can stick them in there. But once again, you can call that whatever you want. Like, you might just have your main drawings here, and then holiday fund or something there. So, because then, you know, one part of it is like the regular amount you take out every month, and then the other part of it is, you know, occasional things occasional things over and above your normal amount that you're pulling out of the business. So it could be like, you know, you're going to the Maldives in like July, and you got paid 7 grand for that, and then you liked it so much that you're going to go again in June or May, and you got to pay another 7 grand for it. So it's somewhere where you can just model some of that. And then, you know, one of the most important things at the bottom is just trying to gauge what your tax bills are going to be. I know for some people it can be quite difficult to work it out themselves, because it's partly based on the kind of profit and stuff they're making. But you know, if you've this is one of the things you can really talk to your accountant about. Or if your business has been pretty much stable year on year, I understand at the moment it might be having a bit of a dip, but ultimately you may be able to just get a good understanding of what your corporation tax bill is going to be like based on what it was like the year before, and then adjust it slightly. And the key thing is, you know, with things like your tax bills, if you work with your accountant to get your tax work done earlier, then you'll still have, like, you know, 6 months to fine tune the figure. So, you know, you might have to pay the tax in September, and you thought it was going to be, you know, 4 grand going out, but then your accountant did the work and it actually turned out to be about 5 grand. Then that's fine, and as long as you've got enough notice and to adjust that figure and see what the difference is. So let's call it. We put some ambitious numbers in here, so I'll have to make the tax bills a bit more ambitious. So yeah, and it might be the case that you're paying VAT every quarter as well. So, you know, that could look like maybe like 9 grand going out there, and And that's just like a sort of place filler. But the idea is, as and when you know your VAT bills and you understand the trends in your business, that's when you can start going in and overtyping stuff. You know, it could be that you've got to pay your self-assessment bill every January, and it's like, well, yeah, I'll just say don't worry about payments on my account at the moment, or maybe it's like, you know, you pay it every July and January, and it looks a little bit like that. Oh, mate. And, you know, because you've got staff, you might have like PAYE to pay. So, you know, you've got a choice. You can either put it under salaries as part of those staff costs, or you might say, well, you know what, I'm going to put it under a separate section here. Or you might say, this is just a PAYE on my director's salary and not my staff. So you've got a few options there, like, so just in a way that kind of works for you, really. But I think this is sort of a basic forecast. So at the moment, it's looking very promising. We're saying we're going to pull in, and these figures are all inclusive of VAT. Just remember that. So if your business is VAT registered, you just want to make sure all the figures you put in do include VAT. So, you know, in this situation, there's VAT in that, and then it's £10,000 including VAT, and then we've got the VAT going out separately out here. So this is loosely what a cash flow forecast really looks like. And one thing I've done here is I've put in a little bit of formatting. So you can see, like, there's 1 month here where, you know, there's a corporation tax bill going out in September. So the business is actually making a net, having a net loss in terms of cash flow. So it's saying that's why this 9,383 is red, because it's saying you're starting on 73,000, losing 9,000, and then you're going to end up on 63,000. So the idea is, like, you know, this is identifying months where you've got less cash coming in than going out. And the main point here is, like, you know, you've got an end bank balance as well. So it's, you know, this is the figure where, you know, for example, there was 1 month where, you know, let's say you decided to just draw out, start to draw out like maybe 100,000. So yeah, suddenly, let's call it 200,000 just to make a point here. Then suddenly this is now showing as a negative cash flow. So you know, in this month, May 21, you're going to run out of cash. So you've got all these months now to actually do something about it. You might decide, you know, the best way to deal with that is maybe take a business loan, and you might talk to someone like James, or you might just say, well, I'm not going to spend 200 grand on a holiday because it's not viable at the moment, and just cancel your holiday. So it's that's kind of the methodology behind this, just identifying if there are any points where you might run out of money, understanding where you need to do something about them, and also understanding, you know, roughly how much money as a surplus you've got every month. Because now I can see it, I can say, well, actually there's particular months where I could potentially invest this money because I don't need to make this kind of surplus every month. And then I might go back and actually say, all right, fine, I'm going to go and hire more staff, and I'm going to use that to grow even more. Is there any questions?
Yeah, I've got one, Nishi.
Yeah.
I do some similar things to this, not quite as deep granular, but I always do it ex-VAT, because I see VAT as a straight through transaction either way. So I just put in the actual cost as opposed to the plus VAT cost. Is there any reason that I shouldn't do that?
So the main reason I try not to do it, like in theory, what you could do is you could, because then you'll end up doing some really detailed VAT calculations, I suppose, because I suppose you'd have to, up here, you'd then have to separate out the VAT in the sales line. And then for all of these different expenses, you'd have to separate the VAT out for all of them and either put it in to a row somewhere else. And then that's when you'd use it to do the VAT calculation. I think it does make it a bit harder. I don't know for a fact. I've always found it harder to separate the VAT out. But I think with this kind of model, you know, it is possible to separate it out. You know, where you got sales C, you could just have a separate line for VAT, like, you know, output VAT, and then down here somewhere you could just have a separate line for input VAT, where you figure out how much VAT you're recovering every month. And then, like, you know, when you're working out your VAT down here, it's just one minus the other. So it is possible to do that. But I think it does require a little bit more calculation. So I decided not to put it in, just to try and simplify the model.
The other point would be that we know, for example, that we're going to have a fluctuation in revenue because we know that's actually planned.
Yeah.
Is there any reason why on the total revenue line,
yeah,
that shouldn't be different each month?
Not at all. I was trying to not rush it. Sorry, I was just trying to make some progress because I didn't want to run out of time at the end. So but yeah, normally when I'm doing this exercise with clients, so we don't use spreadsheets. We use a bit of software called Float. So I created this spreadsheet just for this session, but we use a bit of software called Float, and it models a lot of this automatically, and it connects up to 0 and shows people how they're doing compared to what they thought they were doing. So Float is an amazing bit of software which we give to our clients for free. But what we do as part of that anyway is we look at, and it's been harder with coronavirus, but we've said, look, you know what, if there was no coronavirus, how would you typically have been doing? So we model it based on that. And then what we do is then put in a downturn because of the coronavirus. And then we then put in a recovery at the end. So I typically wouldn't expect that line to be flat at all. Like, you know, a lot of businesses are seasonal. So essentially you would, so a lot of businesses are seasonal. So you might have a quiet summer. Excuse me 1 second.
It's having the baby removed.
Sorry, my wife thought it'd be funny to dump a crying baby next to me. Okay, cool. So yeah, so I would expect seasonality in it. So we've just gone for a quick approach, but you could build like a downturn and then an uplift. So definitely, Mark. Hello.
Yeah.
Oh yeah, okay, yeah. So one thing I think it'd be good to show you guys just before I wrap this all up, because the key thing about a forecast is like you want to be able to use it next month and the month after and the month after that. So what I'm going to just do really quickly now is just show you a really quick and easy way of just replicating this. So one thing I'd always recommend doing is just save the forecast, do a save as, and put it into like a folder on your desktop called forecast, potentially before you replicate it for the next month. Because, you know, a few months down the line or a year down the line, you might want to think, well, actually, what did I believe about my business back then, and how has that changed now? So ultimately, you want to save this down, or maybe save it as another tab as well. You don't necessarily need to create it as lots of different files in a folder. But the key thing to replicating this is I just copy this little black bordered area here, which I've got there, and I will then put it into this little spare category I've got down here. And then all I need to do is just take everything from March 22 up to that point there, and then just put it back into the cell here. And then I just need to put the stuff I put into that spare column. I really hope this works. I should have tested it earlier. And then plug it into where it says March 22 there. Delete what is in this spare column. And then just change the date here. So it says May. And that's how you then replicate it. So then what's happened is all of your assumptions about the business have just moved along 1 month, and then you've added a month onto the end there. And then you'd probably just want to look at your assumptions in April 22 and just make sure they sort of tie in with everything else you've got because I'm assuming your turnover, if you plan some growth in that turnover, for example, then actually you'd then need to go in and just get it to reflect that growth. Is that okay? Did that make sense?
Yeah.
It's good.
Okay, perfect. I mean, so what I'll do is I'll just share this again, and then I just need to put it into the chat box. So I will just add it as a file here, and then you've kind of got the yeah. So that's the updated cash flow that we just created in there. So. I'd love to get any feedback off you guys, like, as and when you're using it, things. I've tried to create a really simplified version of it. So, you might find that it's not completely suitable for your businesses and you have to add stuff. But in general, forecasting has been really valuable for my business. Like, about 6.5 years ago or 7 years ago, when I was a one-man band, I used to create these forecasts and sort of plan the future growth of my business, and just having just having an understanding of what my business would look like in the future, and the decisions I was making in the future it gave me a lot of confidence to really invest the money I needed to get my business to grow.
Okay. Any further questions for Nishi while he's live at your disposal?
Just want to apologise for moving out there. I got a bit of technical issues, but I'm back now.
Okay, perfect. Yeah. What does everyone else do at the moment in terms of keeping track of their cash?
Do you do it?
I look at my bank balance.
Okay. Yeah.
Which, of course, the bank texts me every morning anyway. So.
Yeah.
Nishi, in different times when we had 3 business partners.
Yeah.
Because I'm the finance lead, I produce a report which I used to refer to as my 7 dials report, which is just 7 financial measures for the month.
Okay.
So you can track the pattern.
Yeah.
Things like revenue, expenses, take straight from zero. So revenue, expenses, but then also debtors and that kind of thing, so we can actually see where patterns are emerging. And I've just been doing that, even though I don't actually need to do it anymore. It's just habitual, so it gives me a good indication. I think my accountant thinks I'm a lunatic and looks at it and goes, "Why are you doing this?" But it's just comforting, let's say.
Yeah.
Keeps you happy, doesn't it, Mark?
It does. Keeps me out of mischief.
Okay.
Yeah, it's good.
I mean, my experience is a lot of small businesses don't actually do a cash flow forecast. Their only measure is really what's in the bank account, which isn't necessarily a true reflection of how you are, because it doesn't take into consideration what's due or what you owe. So it's quite a neglected thing, I think.
Well, it depends on how complicated your banking is, really.
Yeah.
If you do have everything pretty stable, you're not going to get caught out. If you have a couple of bigger bills coming up, maybe you will get caught out.
But you often see it, people haven't got enough money to pay the VAT bill or the corporation tax or stuff like that.
Yeah.
Because, they've spent the VAT money rather than stuck it in a VAT account to pay the bill when it's due.
It's worse than that, Paul, now, though, because you've obviously had a lot of people who've deferred one.
Yes,
yeah,
of course, yeah.
And I think also people are going to maybe try to do something with self-assessment, and then they can end up with problems with corporation tax. So I think all this kicking the can down the road needs to be thought through and planned for. And I think that's what's going to catch people out. So maybe at the moment people are feeling quite comfortable because there's money in the bank because they've deferred some costs, but they have got to be paid at some stage.
Yeah, correct. Yeah.
I think businesses that were going to go bust are going to go bust anyway. But what's happening is, and it's the same in the way they've eased the pressure on the NHS by trying to just expand the amount of time it takes people to get the coronavirus. It's all they're doing is just expanding the amount of time it takes for businesses to go bust, because loads going bust all in one go would be a really short short, shock to the economy. Whereas like if they've spread it out over a period of time, then there'll be new businesses popping up at the same time, like the old ones are struggling, and it'll kind of smooth that curve out a bit.
I think we're pretty much guaranteed to have a spate of the usual suspects going bust after they've taken all their furlough payments and everything else. And I suspect there'll be the odd few accountants who will actually advise them to do so.
Yeah, I've had a few clients talking to me about that, but a lot of the time, if people owe money in tax, they also owe their company money through their directors' loan accounts. And if you just shut your business down, then there is a possibility HMRC or some of your other creditors could come after you and appoint an insolvency practitioner and say, what, these people owe me money, but this director also owes the company money. So can you get the money off the director and then utilize that money to firstly pay your fees and then pay me?
I think I've seen that the HMRC has suddenly decided to make itself first in the queue, hasn't it?
Potentially. I don't know legally to what extent they can do that. I'd still need to look into it. Luckily, I don't have that many businesses going bust in my client base, so normally I just send them over to an insolvency practitioner when that sort of happens. But even with insolvency practitioners, it's always a bit of a grey area because they can never completely advise you, because a lot of the time it does depend on how HMRC or your creditors are feeling and their ability to take a risk on trying to get the money off you.